In this week's video, we'll review the latest charts and data to help us understand why buy and hold is great until we'll be moving quickly, so feel free to use the pause button on your video player. The first half of the video will cover topics 1, 2, and 3. And the back half will hit topics 4 and 5. In this segment, we're going to primarily focus on the 1958 to 1974 window. But first, let's take a moment to provide some context so we can understand why that window is relevant to the present-day market. And we can also use the 1958 to 1974 window to discuss this topic. If you've worked hard your whole life, you've invested, and you've accumulated wealth, you're not really interested in participating in this type of drawdown. Average drawdown in these 10 cases in the United States, 53%. And we will also use the 1958 to 1974 window to help explain why we're working so hard and so diligently behind the scenes on this project. And in this segment, it'll also be helpful to keep in mind the topics that we discussed in last week's video. That being, we would manage our portfolio differently and view risks differently in the secular trend windows 1950 to 1968, similar secular trend window 1982 to 2000, and the window in the present day. Our approach and our portfolios look different in those windows relative to this window here, and this window here, and that would even apply to the 1920s. And there's another logical reason why we're going to focus on the 1950s. In June of 2023, in this video, we made a logical case that the present day was similar to late 1956, and that case was made about 10 months ago. So in the next segment, we're going to start in early 1958, and keep in mind the market fell between 1956 in here and 1958 here. So the gains from point A to point B will actually be greater in this example because the market is starting from lower levels. And all of this is relevant to the present day because if we can differentiate between this window here on the left side of the black box and this period here on the right side of the black box, these concepts apply to the last 75 years right up until the present day in 2024. And these concepts in the secular volatility model also have a very high probability of being helpful for many years to come, helping us differentiate between this type of market and this type of market. The fact that NC State had plus 60,000 odds back on March 7th before the NCAA tournament began, and the fact that they're still alive and will play in this weekend's Final Four, reminds us that low probability events can occur in life and in the markets. It's also very easy to get complacent in the current base case, which says we're in a secular bull market. And we know in secular bull markets, if we're patient, really good things can happen. Point A, lower left-hand corner of your screen, basically January 1st, 1958. Point B is the peak in January of 1973. Between point A and point B, the S&P 500 was up over 200%. But we also know that easier markets are typically followed by harder markets. The S&P 500 between point B and point C in 1974 lost 48.2%. Good things have been happening since the October low. We do not want to get complacent with regard to risk management, especially from a long-term perspective. Let's take a closer look at this period in the context of the work that we're doing behind the scenes on the secular volatility model. If we focus exclusively on the secular trend window, 1958 to 1968, patient investors were rewarded. In every case in this window, when the market pulled back here, 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 and here, patient investors were eventually rewarded with higher account balances. And in this window between 1958 and 1968, when we look at drawdowns that were greater than 6%, the median drawdown was a little bit over 10%, the average drawdown just a hair under 14%. And in this window, the gain from point A in the lower left-hand corner of your screen to point B in the upper right-hand corner of your screen was just a hair over 170%. As we walked forward from the end of November 1968, keep in mind the muted draws on the bottom of your screen, because the market's character began to change. Drawdown of 36%, but maybe more importantly, we undercut this low here and wiped out years of progress during this drawdown. And the change in character continued, and patience in this window here was rewarded, but for a very short period of time. This new all-time high window was short-lived and eventually morphed into the 1973-74 bear market. Thus, the model that's under ongoing development is trying to help us discern between this 11-year window here, where the drawdowns were relatively muted, and the market, for the most part, was making a series of higher lows and higher highs, and patient investors were rewarded in a big way over this 11-year window. Thus, if the market's profile continues to look like a secular trend, especially the stronger portion of a secular trend, we would be using mitigation 1 strategies that assume pullbacks will eventually be followed by higher highs. That assumption is based on probabilities. Now, mitigation 1 doesn't mean 100% buy and hold. Why? Because we're not making any assumption that the secular trend profile is going to continue indefinitely, and eventually the data will start to contradict the secular trend thesis, and we can segue from that mitigation 1 strategy to a mitigation 2 strategy. Unlike this window here, for the most part, patience paid off. Not really the case here. For the most part, patience was rewarded with losses and frustration and paid off for a very short period of time up here. And when we look at this impressive gain between point A and point B, and then we look at the give back between point B and point C, it really doesn't tell the entire story from a time and, maybe more importantly, psychological perspective. If we examine this window more closely, it would be very, very difficult for an investor that did all the right things between this point here and this point here, that maintained a 100% no questions asked, buy and hold policy. Because this drawdown here in 1974 takes the market back to levels in 1961. Now, if you're 20 years old, that's really not a big deal. You've got time to make it back up. But if you're 50, 55, 60, 65, 70, 80, and you've worked your entire life, nobody wants to experience, at that age, of the pain of buy and hold when the market wipes out 14 years of progress. And by no means is this a knock on long-term buy and hold. The results speak for themselves. The S&P 500 is hovering right around an all-time high. But there are windows later in life, and it's not just this window here. Something similar happens in the 1920s, and something similar happens between the year 2000 and the year 2013, where the market, for the most part, goes nowhere, with a lot of frustration between point A and point B. Now let's get to the important part of the exercise. How can all of this help us on April 5th, 2024? And ultimately, we want to have a method to discern whether the present day looks more like the left side of the screen in the blue box, or whether the present day looks more like the right side of the screen in the red box. Because when the goal is to navigate between a point A here in 1953 and a point B that could be several years down the road here in 1973, we know pretty much with 100% certainty that the stock market's not going to make that easy for anyone. Thus, we want to be able to use data to help us discern specifically between this type of environment that we want to avoid, 1973-74, and the strong periods of the secular trend, the blue boxes. This is when the market looks the best, your scores should be the highest, and the probabilities are the most favorable. All of this here between point A and point B here in 1968 occurs within the strongest period of the secular trend. So we also want to be able to discern between the blue boxes and the orange boxes, the weaker periods during the secular trend. And that's what all of the previous work and all of the ongoing work is tied to. So you've got 4 primary scores here, and we want to know, how do they look on April 5th, 2024? All of them, again, between 0% and 100%. The higher, the better. The higher, the more you look like the blue boxes. The lower, the more you look like the red box. None of it predicts anything. It just helps us assess probabilities. As you can see, on April 5th, 2024, it doesn't tell us anything about April 10th, 2024, or May 5th, 2024. But on April 5th, 2024, we unequivocally look like the stronger periods within the context of a secular trend denoted by the blue boxes. And we really don't look anything like the weaker periods denoted by the orange boxes, and we don't share much at all, if anything, with the red box that we want to avoid, where years and years of gains can be wiped out. Within the existing market model, the trend strength score and the trend strength long-term score, both of them remain pegged on 100, which would also align with the concept of a strong trend. We've covered topics 1 through 3. Now let's shift gears to interest rates. 10-year yield Friday, April 5th at 11:15 a.m. Eastern Time after the stronger than expected labor report. Trend in interest rates remains up, which is not particularly surprising to any of us, because the base case says the secular downtrend in interest rates that began here in the early 1980s most likely ended in late 2021, early 2022. And yes, yields have risen recently, but from a shorter term perspective, this chart is dated November 9th, 2023. 10-year yield at 4.63%. If we fast forward to Friday's session, April 5th, we're lower. 10-year yield at 4.378. And these scores tell us that the market doesn't seem overly concerned about interest rates at the moment. And a fair question to ask would be, all of this secular trend stuff sounds great, but we're in a different world now. You're even admitting that interest rates have flipped from a secular downtrend to a secular uptrend. That's true, but we have to keep in mind, interest rates were also rising in the 1950 to 1975 window. And within that window is the window that we covered earlier in the video, between 1958 and 1974. And earlier in this video, during this window here where interest rates were rising significantly, we've already shown that the S&P 500 between point A in 1958 and point B in 1973, up over 200%. So it's very difficult to make a rational argument that rising interest rates absolutely positively have to be a showstopper for a secular bull market. That applies to this window here, 1958 to 1968, as noted earlier in the video. A lot of volatility. Why? Because interest rates were rising. Inflation and the Fed were part of the equation, just as they are today. A lot of volatility between point A and point B, but a very satisfying gain of over 170%. So in this type of environment, and in this type of long-term environment, when the trend in interest rates from a longer-term perspective still appears to be up, it's the 250-day moving average in black here. We don't want to let interest rate-induced volatility, inflation-induced volatility, or Fed-induced volatility cause us to take our eye off the longer-term secular trend ball. And from a shorter-term perspective, we should also keep in mind, this is SPY divided by SHY, 1 to 3 year Treasury bonds. You can almost say risk on divided by risk off. During Friday's session, no question we looked weaker during the sell-off on Thursday, but right now, you can make an argument that the upper right-hand corner of your screen doesn't look discernibly different from early 2024 here in January. We should also keep in mind, when we had the 10% correction here in 2023, the longer-term trends are much more vulnerable than they are today. What does that mean? That means we were much more vulnerable from tipping into the orange box profile and out of the blue box profile than we are today. especially from a short-term perspective. Net bottom line, deterioration like this was more important back here, most likely, than it is in the present day. Market breadth has improved. It's still not great, but we should keep in mind when the stock market was peaking here in the year 2000, stock market S&P is on the bottom here. The top panel is NASDAQ new lows percent. So the percentage of NASDAQ stocks making a new 52-week low. We can compare and contrast the trend as the market was peaking in the year 2000 and into 2001 to the trend that we have between 2022 and 2024. And it's the trend that matters. Market breadth in the present day has been improving, which is for the most part the polar opposite to what we had as the stock market was peaking in the year 2000 and started to accelerate to the downside in 2001. We had broad participation intraday on April 5th. Nothing really new on this front. Left side of your screen, IWM small caps. In isolation, this is a good looking weekly anchored volume weighted average price chart, telling us that this weakness here from a probability perspective is most likely over. And that's very similar to the look of the S&P 500 in May of 2023. Mid-May 2023. But if we look at the same chart relative to SPY, notice how a lot of these anchored volume weighted average price lines over here are sloping up and turning back up. On the relative chart, that's not what we have in the center of your screen. They're sloping down. And if we tag the anchored volume weighted average price lines specifically for the IWM relative to SPY chart, we get the same thing. This looks like a downtrend that has a lot of work to do. This is good. It's healthy broadening, but we don't see any significant shifts yet. This is RSP equal weight S&P 500 weekly divided by XLK, the tech sector during Friday's session. RSP underperforming XLK this week. Value stocks underperforming growth stocks by 1.2% this week. RSP underperforming XLK by 1%. IWM small caps this week underperforming by 1.8%. And maybe more importantly, it's the slope of this 250-week moving average in black on each one of these charts that tells us the longer-term trend favors XLK over RSP, SCHG growth over VTV value, and the S&P 500 large cap relative to small cap. All trends are subject to change, but these trends haven't changed yet, and any outperformance by RSP, VTV, and IWM, relative outperformance, in the short run would be classified as a counter-trend rally within the context of an existing downtrend. So healthy broadening out over here, and that would include RSP, VTV in isolation looks good. All of these ETFs look good in isolation. But we don't see signs or significant shifts relative to long-term leadership at this point. In summary, the secular trend remains firmly intact, and that's based on the facts that we have in hand today. If those facts shift in a material manner, we'll have to reassess those probabilities. Economy and labor market remain healthy at this point. And a very favorable monthly labor report on Friday, April 5th. So we want to have a long-term focus as long as the data allows us to do so. And we all know that volatility, givebacks, corrections, feeling uncomfortable, pain, red screens, drawdowns, they're all 100% normal and to be expected. But eventually bull markets, by definition, after volatility, givebacks, and corrections go on to make higher highs, just as we did after the correction in 2023. We went on to make a higher high. The same is true for secular bull markets. Just as we did after the 2022 bear market, the secular bull eventually went on to print a higher high. The whole purpose of the secular volatility model is to test the secular trend thesis. We'll learn something if the data starts to veer from the base case. That may happen. It hasn't happened yet. We don't want to make any assumptions regarding any topic on any time frame. And as we all know, The only way that all of this can work effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.